The new mortgage fees are getting people upset. It's been a source of confusion, and I'd like to do an explainer on mortgage pricing and how to better understand new government regulations. I was a banker in my past life, and some of my economic research has been on mortgage pricing, so I'm actually excited to tackle this one. The source of confusion stems from some of the news headlines suggesting that new mortgage pricing causes people with good credit scores to pay more for mortgages than those with bad credit scores.
Home buyers with good credit scores to higher mortgage fees, while riskier buyers will get more favorable mortgages.
The administration rule is set to take effect that will force good credit home buyers to pay more for their mortgages to subsidize loans to higher risk borrowers. Let's go out now.
This is not correct. Let me break it down. First, we need to understand how mortgage pricing actually works. It's complicated, and there are many different mortgage products out there. So to help us, we're going to focus on government-insured loans or conforming loans. For your reference, conforming loans account for 85% of all loans. That's 2021 data. For conforming loans, there's usually a base interest rate that fluctuates with the market. It's real-time adjustments to market changes. The lender then makes modifications to that base interest rate based on additional risk factors of the borrower. And there are many adjustments to actually consider. There's an adjustment for property type, whether it's a condo or investment, for instance, whether the house is a second home or a primary home. The loan-to-value ratio is also considered. Usually, the higher the risk, the higher the added risk adjustment. The misinformation about the government penalizing good credit borrowers stems from the credit score adjustment. Let us take a look at the adjustment for purchase loans across credit scores and loan to value. This is the May 1 proposed schedule. As you can see, at all loan to value ratios, the risk premium decreases as credit scores increase, meaning that individuals with better credit always pay less of a risk premium compared to individuals with lower credit scores, meaning that they are high-risk borrowers. The confusion stems from mistaking changes with levels. Levels compares the difference between high credit scores and low credit score premium, which we just did. What others are doing is comparing the changes for each of the credit score categories. So they're comparing the risk premium for high credit scores before and after May 1, then comparing that to the changes in premiums for low credit scores before and after May 1. In that case, what has happened is good credit score risk premium has increased and low credit score premium has decreased. And this confused the market and generated the language that high credit score individuals are being penalized, and that took over the news. The reality is the adjustment happens all the time and depends on risk changes and portfolio consideration. So rate sheets is what we call them in the industry, change all the time. So the reality is good credit score individuals still pay a lower risk premium than the risky individuals with bad credit. The difference is the gap has narrowed. So here's an example of two individuals that are looking for a loan with 80% loan to value and look exactly the same, with the exception that one borrower has a credit score of 740 and the other has a credit score of 640. Based on current guidelines, the risk premium for the low credit score individual, that's in red, is 3.25%. So they would pay 3.25% above the base interest rate. The good credit individual is less risky and would pay only 0.5% above the base interest rate. After May 1, the bad credit individual would pay 2.25% above the base, and the good credit individual would pay 0.88% above that base rate. Good credit is still paying less than bad credit, but the gap has narrowed. Saying that good credit individual is paying more than the bad credit individual is actually false. I'm not here to discuss if the policy is a good or a bad policy, just wanted to point out what is going on and how to process that information. Here's a side note for you. I will caution you that this discussion is only about the base interest rate approved by conforming guidelines. The lender still has discretion to add and subtract from the interest rate based on how much money they want to make and the lender's portfolio needs and based on the customer's negotiation skills. And that is what I wrote my dissertation on. Just wanted to clarify this change in the market and hopefully avoid more confusion. If you found this helpful, please like or leave a comment. It will help me reach more people. See you all next week.